Coming up in today's show, stocks extend the post-Fed rally, retail sales come in better than expected, 10-year Treasury yield falls below 4%, Buffett buys the dip in oil again, and why I think the stock market has put in a short-term top. Welcome back to the Click Capital Daily Market Show, everybody. Hope you're doing well. My name's Jared. I'm going to get you up to speed on everything that's happening across financial markets with a curation of the best financial content, fundamental and technical analysis across all the most important charts out there. And just looking at the indices today, you would think it was another really bullish day. It's pretty much all the indices finishing up. However, looking underneath the hood, it was quite a checkered breadth day. Actually saw a bit of softness in mega cap tech, especially the software sector. Consumer defensive and healthcare stocks fell along with utilities. However, we did see some good strength in energy, oil and gas, industrials, and continued rip-ups in regional banks. And so here we are on the charts. The S&P 500 has now entered what I'm calling the all-time high resistance zone. And just flipping over to a weekly chart to show you that, that's back at the start of last year when the market peaked out at 48.18. So we're 99 points away from all-time highs on the S&P 500. And just going back down to the daily chart, this could be a point where the market may stall out and consolidate around these all-time highs. And I'll show you why I think that could be the case. First of all, just looking at the candlesticks, we've got a little bit of a shooting star here, and this could be potentially setting up for an island reversal. Since we gapped up, put in a bit of a doji, if we gap down tomorrow, that could set up an island reversal formation. Just looking at my dynamic swing index, DSI, which is my improvement on the RSI, is really elevated there at 19.4. And looking on my hidden divergence indicator, that's showing a big, massive bearish divergence. And that's also showing up on the NASDAQ index as well, that bearish divergence. It's also oversold. And looking at the Dow Jones Industrial, we can see here on my VWAP Extremes indicator, we're currently 6.8% above the 50-day VWAP, which is its most extreme reading over the last year. And looking at the Russell 2000, it's 12.5% above its 50-day VWAP, which it too is the most extreme reading over the last year, in addition to the hidden divergence we've got going on. Also, we just had a wild day in the options market for a Thursday. A huge 60.3 million contracts traded with massive lopsided 64% of them calls. And that to me screams blow off top. Basically everyone piling into calls trying to chase this rally up in what could be a little too late to the party. Also got the fear and greed index quite elevated here at 71. This is levels associated with short-term tops. And same with investor positioning now. The AAPL investor sentiment survey, bullish reading coming in at 51.3% today. That's around the same level when we last peaked out in the market in late July. We've also got bearish readings down near lows as well. And looking at my custom indicators, institutional buying percentage, that's still in the neutral zone but has been dipping down. And what really caught my eye today and is making me think we could be at or near a short-term top is my S&P 500 oscillator coming in at a huge 69.62 reading. That's one of the biggest readings it's put in for years, and I've never seen it go above 70, which shows the market is super stretched. Sentiment is super high and everyone and their dog is long this market. And for a bullish day in the market, the VIX actually ended up 2.3%, and I can see volatility risk premium starting to increase as well. The amount option dealers are asking for their implied volatilities, and look at that put call ratio in equities, 0.65. That's super low, and the skew blowing out as well. Let me just take you out to a weekly chart on that one. So the skew shows the price of out of the money put options on the S&P 500, and that'll typically rise before the market rolls over, and then when the market rolls over like it did last year, the price comes down. So you could think of it as like flood insurance, and before the flood, the price of premiums goes up. Then once we've had the flood, the price of premium comes down. And just look at that move up over the last week. So I'd say there's a good chance the market could be running out a bit of a steam here, at least in the short term. And we did put in a big volume day, even though it was a low range day on this kind of spinning doji. And just before we continue the daily show, if you want to get access to all of my custom indicators for TradingView, like the ones I just showed you, then come to my website, clickcapital.io, click on this big red banner up the top, and take advantage of my Christmas special to get lifetime access to all 22 of my indicators with no ongoing costs, as well as my latest investment presentation on a micro cap stock I've recently invested in. It's up almost 15% since I first made the presentation. However, I think things are just getting started here, and I'm looking for at least a double or a triple on that. And so you can get access to all of that just for the one-time fee of $249, and that comes with a 7-day money-back guarantee in case you change your mind. So if you're interested in learning more about that, click the link below this video in the description and take advantage of this special offer. Just moving on with today's news, we got retail sales coming in stronger than expected. Economists were actually expecting them to fall 0.2% for the month of November. It actually rose 0.3%. And it's no real surprise with unemployment at 3.7%, gas coming down a lot. The consumers are still out there in force and doing a lot of buying. And so there's no doubt the US economy is holding up. And after Jay Powell's about face yesterday coming out really dovish, markets are declaring victory and saying that the soft landing is basically here. Everything is A-OK. However, what did make Jay pivot from being quite hawkish for over a year now to actually saying, no, hang on, I think we're done and we're going to start cutting rates a lot more than we expected? What has he seen that spooked him? Or is it politically driven? Because it is very convenient to signal dropping rates early next year when the US government has almost a third of its outstanding debt to refinance next year, which is very expensive if rates were to stay above 5%. Not only that, we're going into an election year. Lower rates is going to help Biden's chance of being re-elected, which could also help Jay's chance of staying in his job. Because typically, the Fed won't cut rates and get dovish until they see some weakness in the economy, and that weakness should outweigh any inflation concerns they have. And so we've still got core inflation at 4%, and I'm sure you all know price of food and many other things certainly isn't going down anytime soon. And now we've got yields plummeting. Got the 10-year below 4% today. Risk assets hitting highs. That could actually set up a scenario for inflation to uptick again, and it could be a case of too much of a good thing. So is Jay's actions partially politically motivated? Or does he really see inflation going down to 2% next year? Or does he see something that makes him think that a recession is just around the corner? Because looking at Fed fund futures pricing, they're going a whole step further than what the Fed is forecasting. The Fed's implying that they're going to cut rates about 3 times next year, 0.75%. However, Fed Fund Futures saying it's going to be more closer to 1.5%, double. And that there is more than just inflation pulling back and soft landing. That there looks like pricing in hard landing recession, which could actually be convenient for the US government and Treasury in order to refinance almost 1/3 of its outstanding debt. But regardless of the reasons why, stock market doesn't really care for now. Got a big bullish consensus out there. A lot of people saying this is the start of a new bull market. Even got one investment advisor today saying US stocks will be the best investment over the next 5 years with potential upside of 100%. As if valuations don't matter anymore, and the record inverted bond yield curve is going to get it wrong for the first time. But with the 10-year closing below 4% today, you could almost consider that as a signal that the economy is going to weaken, and the bond market continues to expect a recession next year. And just look at that pullback in the 10-year. It was just a month and a half ago we were pushing up against 5%, and here we are today at 3.92%. Same with the Fed sensitive 2-year. That got up over 5.2% recently, and actually got down a bit below 4.3% today before being dip bought. But on the back of those retail sales and a bit of a jump we got in crude today, we did get the spread of inflation expectations popping up a little bit, which has been helped out a lot by the fall in oil because of record-breaking oil production from the US. It's left OPEC with its lowest crude market share in nearly a decade. That's dropped down to 51%. In addition, we've seen weakening oil demand as we've still got really soft Eurozone and Chinese economies, along with Japan and others still flatlining in GDP. However, we've got a bit of a dip in the dollar today, falling down into oversold territory at 101.50. That really helped out the price of hard assets, like crude, which got a nice little pop here today after briefly touching those mid-67s. Here we are at 71.50. And like I've been saying, there's a bit of a support zone from back in the middle of the year where we touched those same levels. And just like back in the middle of the year, when oil was down in the high 60s, Warren Buffett was buying the dip in his favorite oil stock, Occidental Petroleum, and he's just done the same again, buying $600 million of shares, taking his stake up to now 26% of the company, worth about $14 billion. And just looking at the chart of Occidental, we can see just like crude, it came down to those same levels we saw back in late June. It was technically oversold. Warren Buffett was buying that dip. The news came out and we've popped up 2.69% today. And according to my stock fair value indicator, which you can get lifetime access to as part of my Christmas special, shows a fair value on every single stock around the world, no matter where you are. It's my own unique formula based on a company's assets, liabilities, growth in the business, and future projections of earnings. It's got Occidental fair value heaps higher at $296 a share. And so Buffett too sees value here, and he is pretty good at buying the dip in these large cap names when they go on sale. So looking back in a couple of years, he is probably right again on this one. And I'd say if we were to break that 67.50 on crude and go down into low 60s, Buffett and other big value investors are likely going to keep buying all the way down in their favorite beaten down energy stocks. With that dive in the dollar, we've got a bit of a rally happening in precious metals, with gold approaching back to all-time highs, along with a good pop-up in silver. And so the lower rates go, the more appealing gold's going to become. And just looking at the daily chart, we got that big reversal candle at the start of last week. We hit all-time highs above 2100 and a big influx of selling come in. We just got a bit below the 50-day VWAP and we've popped back up there. And it looks like we may take another stab at all-time highs over the coming days and weeks. And any asset hitting all-time highs is one of the most bullish signals out there. Because if you think about it, when something's at all-time highs, there's no long position out there that is underwater. Everyone is in the money and wants to hold and see how much further it can go. And that can kind of feed onto itself and we get that nice parabolic uptrends, just like we've been seeing in the price of cryptos and Bitcoins for the last couple of months. And it too is approaching new year-to-date highs and continues to trade technically well, along with the second biggest crypto out there, Ethereum. Looking across the world, most central banks are pretty much on hold. We had the ECB keep their rates on hold today, and the European Central Bank President, Christine Lagarde, pushing back against any talk of rate cuts. She's acknowledging there's still inflation out there. Eurozone's pretty much in stagflation, flatline GDP. The price of goods and services still growing more than they should. However, just like Fed fund futures, market pricing for the Bank of England and ECB, rates are showing around 200 basis points of cuts come mid-2025, and so bond markets around the world pricing global recessions in for next year. That's a big macro view. Looking under the hood today, we've got some really strong pops in some individual sectors like solar stocks and clean energy ripping up higher today, and they've been really sensitive to interest rates. As part of the challenge facing the sector has been elevated rates denting demand as homeowners struggle with higher financing costs. And we can see this really bullish price action in the solar ETF TAN, up 8.1% today on almost triple average daily volume. And the winning sector today out of all the sectors I track, clean energy, up 6.7%. Looks like we may have put in a bottom here. Got some big bullish divergences on my indicators, and it could be a case of this sector catching up to the rest of the market, which still has a lot more work to do. We've also got shares of Intel breaking out to yearly highs as they unveil a new AI PC chip and server processor to compete with NVDA and AMD. And those of you who watch the channel know I've been talking up Intel for a few months now as a good catch-up trade, and the US kind of needs them to succeed in order to deleverage from Taiwan and relying on China for chips, which is a key national risk. And Intel already has the infrastructure to scale up and sell a lot of AI chips, and they were the leader in chips for decades, only recently been knocked off their perch by NVIDIA in the last couple of years. And just looking at the daily price action Intel, we are getting a bit of a bearish divergence here, but we did break out to new highs today above $47, so we may have a bit of a short-term pullback, but I think Intel is still a good play with the political tailwind of US looking to reshore domestic production of critical products like chips. We're also seeing banks, regional banks, and asset management companies trade up really sharply today and over the last month, including Charles Schwab, which saw a rebound in their core net new assets. But more importantly, these big drops in yields is helping to lower the unrealized losses they all have on their balance sheets with bonds. It's taking a bit of that risk out of the market. And we can see that in this price action in Charles Schwab, ripping up 7% today. That's a huge move for a company with a market cap of $129 billion. And it's been quite the bounce since we hit those lows just below $50 a share in October. And once again, that was coming off a really undervalued base as well. My stock fair value's got it at $90 a share. So this thing still has room to rip. And look at that price action in regional banks. 4.8% today on huge volume, and just loving those lower bond yields and kind of putting an end to those huge unrealized losses on their balance sheet. So looking at economic data today, there's those retail sales coming in much higher than expected, and jobless claims coming in a bit lower than expected, showing the jobs market still holding up pretty good. And corporate insiders continue to do a bit selling up here with not too much buying either. Looking at breadth today, we had a huge 1,208 stocks and ETFs hitting new 52-week highs. Some of the notable ones: Apple, AMD, Amazon, Intel, Home Depot, JP Morgan, Arc Innovation, Visa, and a bunch of financials and industrials. On the other side of the coin, we've got 50 stocks and ETFs hitting new 52-week lows, mostly just short ETFs and nothing too much else of note. Got 87% of stocks above their 20-day average, and a similar pattern back in mid-late July when the market last topped out. And look at that in the traditional NYSE new highs. That looks like a bit of a blow-off top to me as well, 303 against two lows, and the Nasdaq as well, 223 versus 16 lows. And we got a bit of a backwardation in the VIX one day. Tomorrow is quad witching, third Friday of December, where we've got stock options, stock futures, and futures options all expiring. And it looks like option dealers have increased their implied probabilities going into that. Still got the spread of bond volatility versus stock volatility at all-time highs. Another big pop-up in TLT, the yield's fallen down, but high-yield bonds stalled out a little bit, finished a touch lower. Commodities had a nice pop today after that lower dollar. And for my regular viewers, you know I'm very bullish long-term uranium, and we just broke out to new year-to-date highs today and coming up to that big resistance from late 2021. And uranium's had a great year, up almost 50%. And I think this could go into a secular long-term bull trend as the world comes back to uranium as the most efficient, clean source of energy if done right. International stock indices weren't all that bullish for a Thursday after America's great Wednesday session. Still got the China index sitting at 52-week lows, with the Nikkei going sideways and the Aussie 200 looking a little extended here. Huge day for high beta stocks versus low volatility. To me, another sign that we could be at a blow off top, but a bit of a pullback in growth stocks versus value, now back down below the 50-day. And look at that move up in small caps versus large caps. May have put in a decent bottom here, and who knows, maybe a multi-year bottom. Over to stock sectors, and apart from clean energy, there was home builders ripping up today, loving those lower rates. Regional banks, and another good day for REITs as well, with a bit of a pullback in the defensive sectors, healthcare, staples, and utilities. Huge rip up in BlackRock, 4.3% today, taking you out to a weekly chart on BlackRock. Looks like it's broke above this big resistance zone, and that could be a good signal for the market medium term. Even though we may be close to a short-term top, medium term, the market still may have a few more months to run before we put in a medium-term top. And some pretty solid pops in the two biggest oil stocks, ExxonMobil and Chevron, having a nice bounce off this base. There's Apple with a spinning doji, and Microsoft actually touching its 50-day today, and not too much action coming out of NVDA. Although we did get a nice pop with Tesla, and a bit of a fall there from Adobe after reporting earnings, mostly in line with expectations. And the meme crowd is well and alive. Look at these pops across the board. Carvana up 12%, Nikola up 13%, Lucid up 14%, GameStop's been ripping up, and C3AI. Typically, meme stocks are a good contrarian indicator when everyone's piling into meme stocks, typically when the market is topping. Active today was Foot Locker. Got an analyst upgrade up 10%, coming from a low base. And this too is another undervalued old economy stock, and a lot of brick and mortar retail's been hit hard over the last couple of years. You know, it's a trend that's been going on for 10 years. Amazon eating all their lunch. However you think about it, buying shoes physically should always remain a thing. I don't know about you guys, but I don't think I've ever bought shoes online because you always like to go and try them on, have a little walk in them. And so I think Foot Locker, being the leading brand, is always going to be around. And their market cap, even after this big pop, pretty much doubling in price in the last couple of months, they still only have a market cap of 2.9 billion, and they consistently do yearly sales over 7.5, 8 billion, and my stock value indicator's got them at $60 a share. So once again, this is another old economy stock, value stock, I think could outperform over the coming year or so against these high growth, really priced stocks out there. Got a bit of a pullback in the defense contractors today. There's Alibaba trying to put in a short-term bottom. Another one of my favorite old economy stocks, General Motors, ripping up really nicely here today, 6.6%. No bearish divergences. I've still got that one as significantly undervalued as well. And a bit of a nice move up in Walgreens, breaking out to multi-month highs, along with 3M and the telecoms as well. So we've had that pretty good bounce in those beaten down old economy stocks that I was buying down here, and telling you guys on the daily show as well that I was doing that. And look at that uncoiling and some of those beaten down regional banks today. Huge pop-ups, along with the big guys. Bank of America up 6%, Citigroup up a little bit, Wells up 5.7%, and Schwab, like we just talked about, putting in huge green candles today. Okay, so there we are, guys, on the S&P 500, and what I'm calling the all-time high resistance zone. All-time highs less than 100 points away at 48.18. And just looking at my indicators and everything I've showed you today, say there's a chance we're at or close to a near short-term top. Looking at that options market, the huge amount of calls. My S&P 500 oscillator at a record just below 70, and the market's pretty much been on a 600-point parabolic rip since then, and it just feels like things may have just got a bit too bullish. The consensus is very bullish, and just looking back in history, this is generally a time when markets put in short-term tops. Doesn't mean it definitely is. We're just looking at probabilities here. But either way you look at it, we are quite stretched. And those coming in long now are pretty late to the party. So we'll just have to see what happens tomorrow. Quad witching. We already had a huge day in the options market. Tomorrow could be even bigger. And who knows, we may get one final last push up to that all-time high. And that's most likely going to trigger a lot of longs and systems. And we could put in one crazy blow-off top candle. Or we may just gap down and we could create that island reversal formation I was talking about earlier. Either way, it's been quite the remarkable rip, and looking in the Russell, there's nothing wrong with profit taking into these big green candles. Been doing a little of that of myself, and I would be really surprised if the market could keep ripping up in a parabolic fashion like it has been from here. That's all I got for you today, guys. And just before I go, if you want to get lifetime access to all my indicators, plus my latest investment presentation, this is one of the best prices you're going to get them for. $249, one-time fee, no ongoing costs. And that includes future access to all indicators I develop in the future as well. So click the link below the video to learn more about this deal. Other than that, come back to the Click Capital channel tomorrow and we'll see what Quad Witching Day brings us. See you then, guys. Cheers.